So, Brian, we've got the end of the tax year coming up. We've just lost 50% of our audience in that first sentence. So, what is it? When is it? What should people be doing before the tax year ends?
Yeah, we certainly shouldn't lose the audience because it's a massive opportunity. The saving, investing, and retirement environment in the UK is quite generous, actually. We get quite a lot of allowances and reliefs to help us save and invest. The issue, or why tax year end is such a big thing, is most of those allowances are use it or lose it allowances. So the end of the tax year is the 5th of April, so next week as we record this. And once the clock ticks midnight over into the 6th of April, you get a whole new set of allowances that you can use for next year, but you can't pull many of your allowances for this year forward. So a lot of them, as I say, are use it or lose it. So that's why you'll see a lot of communication from financial services and fintech firms just reminding you of these because they're incredibly valuable and you can't carry most of them over into next year. So that's why it's so important and important for savers, investors, people planning for pensions and retirement and anything. It's relevant to most people.
Mm-hmm. And for things like what to do, so I know you've got some specific things that you would advise people to take advantage of. So what are some of those things?
Yeah, so there's a little bit of something for everyone in the various kind of allowances. I would always say the first step for people is to work out as much as you possibly can do what your financial goals are at the moment. So people, for example, might be saving for a house, or they might be saving for their family, school fees, saving for holidays, saving for financial freedom, the whole FIRE movement, saving for retirement, whatever that might be. If you've got some sort of vague idea, or better yet, a specific idea of what your financial goals are, you can start to work out which of these allowances make the most sense for you. So if I just take one of those, for example, so we have a lot of people here at Moneybox who are trying to save for their first home. And there's the lifetime ISA there, which gives you up to £1,000 of free money every tax year towards that purpose of saving for your first home. There's a secondary objective. You can use it for retirement as well. But a lot of people are using that one for their first home. And as I say, you can put in up to £4,000 a year, and then the government tops that up by 25%. So you can get £1,000 free from the government towards those goals between here and next week. And then you can do it again the week after into the new tax year. So between here and a couple of weeks' time, you could have £10,000 into that lifetime ISA. 8,000 of that would be you, and then 2,000 would be a free top up from the government. So given the situation that we're in, and in terms of cost of living and all that sort of stuff, these are the types of things we should be trying to take advantage of as much as possible. And that's just one example of the various allowances available to us.
Yeah, everyone loves free money, but not everyone knows about all these kind of incentive schemes and government schemes. And the other product that, you haven't paid me, well, you did pay me a £5 before this, but the Moneybox stocks and shares ISA, I actually use it. I'm actually a user of Moneybox. Very, very cool product. Is there any kind of incentives around that, investing and putting money aside?
So there's massive incentives of that one. They're just a little bit less kind of day one incentives. They're more incentives that you accumulate over time. So the stocks and shares ISA, you can put in up to £20,000 per tax year, inclusive of the 4,000 in the lifetime ISA if you wanted to. So say, for example, you could put 16,000 into a stocks and shares ISA and then 4,000 into a lifetime ISA, or you can do the whole 20,000 into a stocks and shares ISA. So that's your contributions. And then hopefully over time, if you're listening to people like Finimize, your investments will grow over time. And all of that growth for you is tax free. So there's no capital gains tax, there's no income tax, there's no dividend tax. And people have built up huge sums in ISAs over time. So it's not necessarily something that you're going to see an immediate top up from the government like you do with the lifetime ISA. It's a benefit that accumulates over time. And you need to be a little bit kind of patient with it, but it's a huge benefit not to be paying capital gains or dividend tax or income tax on your investments, because outside of ISAs, the regime around capital gains and dividend tax is tightening a little bit. The allowances that we have there are coming down significantly over the course of the next 1 or 2 years. So if you're investing outside of ISAs, you'll likely be paying kind of more tax. So the freebies that the UK government does give us to save and invest more are just becoming ever more important because of the taxation regime outside of ISAs.
Mm-hmm. Yeah, really, really interesting. And talking about change, we obviously had the spring budget very recently that you've kind of written a really insightful piece about. Pensions, energy price guarantee, childcare costs. What do investors need to know? Like, what are your few key takeaways from that statement?
Yeah, there's a couple of things. There was a lot of headlines around pensions after the budget because there was some eye-catching things in there, specifically for kind of financial advisors, financial planners, things like the annual allowance of what you can put into pensions is going up from 40,000 to 60,000 a year. So you can put in 60,000 into your pensions, which, as I said at the start, is quite a generous regime. You don't see that replicated around the world, really. They also removed something called the lifetime allowance, which was set at just over £1 million. And above that, if you were in a fortunate position for your pension to be worth more than that, the tax above that amount was pretty punishing. So they've removed that and they've increased the amount that you can put into your pensions on an annual basis. So for high earners, the environment around pensions has become even more accommodating, frankly. But I think for me, one of the even better things is a lot of the benefits around pensions that are available to all of us, not just kind of high earners, are still there. They didn't fiddle with things like tax relief for your contributions. They didn't touch things like employer contributions going into your pensions, which is all incredibly positive. And it's just a reminder that there's a massive helping hand out there to save for your retirement. People can kind of get scared in terms of the big numbers when you put into kind of pension calculators and that sort of thing, in terms of the amount that we're all going to need to save for anything resembling a kind of comfortable retirement. But the thing that I always remind our customers is you're in no way are you doing this alone. You have your contributions that will go into your pension. If you're in salaried employment, your employer should be paying into your pension as well. And then effectively the government is paying in quite a lot into your pension as well in the form of tax relief, which, quite like the lifetime ISA bonus that we talked about earlier, the tax relief from the government is just free money going into your pension as well. So as much as it was interesting to see the increase in the annual allowance, reduction of the lifetime allowance, all that sort of stuff, I was even more positive about the fact that all of the benefits that are there for everybody for their pensions, they weren't touched or reduced, which is great because the government does want us to be saving more for our retirement. And it's up to all of us to kind of educate people in terms of all of the benefits and the free money that's on the table going into pensions.
Yeah, it's definitely a massive macro theme, right? People paying into their pensions, having enough to actually survive afterwards. So yeah, very important to learn about these kind of allowances and, actually contribute. But obviously in this cost of living crisis as it is, it's quite tempting to dip into that pension or lower your contributions to cover things like rent, heating, all of these different types of things. So it's a very difficult time, particularly in the UK. Every bit of data we get out, if it's UK inflation or, food prices today, up 19% year on year, which is insane. Definitely when I go to Tesco's, I get a few items and it's 50 quid and you're like, it's pretty crazy. One of the things that didn't change in the budget, something that we talked about in the previous section, which was ISAs. So is this good news? How should people use them effectively?
Yeah, it is good news. I think part of the pushback on the pensions changes has been it's very difficult to plan when the government keeps changing policy. And thankfully, that's not been the case in the ISA world for quite some time now. The allowances there have remained pretty constant. We would like to see some increases in line with inflation kind of going forwards. There is a little bit of a problem there, but the fact that they're keeping the policy the same and they're keeping the allowances the same makes it a little bit easier for people to kind of plan going forward. So as we talked about, you've got your £4,000 that you can put into a lifetime allowance, into your lifetime ISA. You've got £20,000 that can go into your ISAs overall. And as I say, this is a pretty generous saving and investing regime that's not really replicated around the world. So people should be looking at their financial goals. And if they have savings and investing accounts outside of ISAs, they should start to look at these tax wrappers because they really protect you from paying unnecessary tax. And again, something we're seeing a little bit more at the moment. For the last 10 years, when interest rates have been absolute rock bottom, it's not really been that important to keep your cash savings in an ISA or in a wrapper, because you've been very unlikely to be earning enough interest to be paying tax on your cash savings. But with interest rates going up as much as they have done, people are earning a little bit more on their cash savings. So it's worth looking into as well whether you need to be placing those into tax wrappers to protect you from unnecessary savings tax on the interest that people are now earning as well. So it's a really important tax year end, probably one of the most important ones in a long time, because interest rates are going up and because of the taxation allowances outside of these wrappers is becoming a little bit more punishing next year.
Yeah, lots of things to be doing, which transitions nicely into kind of the next kind of topic, which is obviously the macro, super difficult right now with inflation. Interest rates are budging up, but maybe not so much in your current account and things like that. Food, energy bills are high, food bills are very high. What are some of the things that our listeners can do to protect themselves during this kind of cost of living crisis? How important is investing to protect that, that monetary base that you're building up to build for your future? What are some things that people should be doing right now to really protect themselves?
Yeah, I think we're super aware of the cost of living crisis. Like, you can't ignore it. As you say, when you go to the supermarket and you see your bills going up, as you say, 19% food price inflation came out this morning, which is just crazy. And it can become very difficult to be optimistic and keep planning for your future and keep doing things like your pension contributions. So kind of on a personal piece, on a macro, like looking at your overall situation, I would say try not to lose track of your future financial goals if you possibly can do, and try and keep something going towards your future you. So you mentioned earlier, it can be quite tricky at the moment to think about your pension contributions when we have so much pressure on our wallets in terms of energy price and food inflation and all that sort of stuff. So I say to our customers, when that question kind of comes up, okay, reduce your contributions if you have to, going into your pensions, your ISAs, your savings accounts, but try and not switch them off completely if you can at all avoid it. Try and keep something going towards your future you, because we will weather this storm, and there is signs that inflation will hopefully come down towards the end of this year. So it is important to keep money going towards those kind of future financial goals. Some other things that I always say to people is, one, like, it can be difficult to keep looking at your outgoings, but I always recommend to people to check and see what you're actually spending your money on a monthly basis. Even if all of it is absolutely mandatory, it's good to see what is coming in and out of your bank account on a monthly basis. And then going back to what we talked about at the start, just seeing what is there to help you with your financial goals. As you say, going back to these allowances and reliefs that we're given, there is helping hands there towards buying your first home, saving for your family, saving for your retirement. So starting to investigate what helping hands are there from the government to help kind of weather this storm. The lifetime ISA, that 25% bonus, that's one of the few inflation busting things that's out there at the moment. Getting a 25% immediate top up on your savings is incredibly important when inflation is running at double digits as well. So there's things out there. It's just about trying to find what's suitable for you and what you're trying to achieve over the next 1 year, 3 years, 5 years, 10 years.
Yeah, and you've got a really kind of unique perspective at Moneybox because you have so many customers. Is there any valuable insights that you can share with us about what people are doing, what they're requesting, what's top of mind for them? What insights are you getting from your community and your customers that is interesting to you and is driving, let's say, your product decisions and your overall kind of take on the health of the consumer and what the appetite from the UK kind of public is?
Yeah, there's probably two things. Like, people originally probably knew Moneybox as the kind of roundup saving and investing app, and we've moved beyond that now towards kind of a full suite of products in terms of retirement, home buying, that sort of stuff. But if we look back at just the consistent kind of deposit behavior of our customers, it's been remarkably resilient over the course of the last kind of 12 or 15 months as this cost of living crisis has really taken hold. We look at those numbers and it would be perfectly reasonable to expect people to be lowering their contributions or switching off their contributions into their savings accounts, but we don't really see any sign of that at the moment. So it does show a little bit to look beyond the headlines and to what people are actually doing. And we are still seeing people really, really focused on what they're looking to achieve, be it home buying, retirement, savings, investing, whatever it might be. So people have been really resilient in that area. We also have a team of brokers here that do mortgage advice, and they are still extremely busy. So you see the headlines around interest rates, mortgage rates, house prices, all this sort of stuff. And again, you would expect that to feed through into the activity levels of the broker team here. But they're still incredibly busy. So people are still achieving their goals. They're still buying their first house. They're getting their keys to their first home. They're still saving and investing towards their pensions. So that's not in any way to minimize the cost of living crisis. It's incredibly difficult, and we're trying to support our customers as much as we can through this time. But we're also saying don't be disheartened and still be optimistic about hitting those financial goals, because people are doing that on a day-to-day and week-to-week basis as well. So the picture that we're seeing is not quite potentially as pessimistic as you see just from reading some of the headlines that might be out there.
Yeah, that's really interesting. It's so important to get kind of insight from those that are actually collecting the data points, those that are actually seeing money flowing and being able to analyze behavior rather than just that kind of headline risk of the world's going to end, which we're all kind of used to by now. I'm glad you kind of brought up home buying, just because, you obviously got, mortgage advisors and things like that. The UK property market is so important. It's almost ingrained into our kind of psychology as well. But it's, somewhat of a different market, I would say, to, let's say, the US and others, mainly for our audience, that many people in, other markets fix their mortgages, right? For 30 years, it's quite common. There's a higher percentage of people that buy houses and have a 30-year mortgage in, let's say, the United States, which means that they're more protected from interest rate rises and things like that. We don't have that luxury here in the UK, many kind of like New Zealand and Australia and other kind of very interest rate sensitive housing markets, mainly because we have floating rate mortgages, we have short-term fixed mortgages that then, many of them, or a high percentage of them, are actually running out this year. So my question to you is, what kind of activity are you seeing from those maybe that are running off their mortgages, their short-term mortgages? Is there concern? Is it busy? What kind of insights can you give on just the general housing market, let's say, in the UK?
Yeah, it's very busy, and that's not surprising that people are in more need or desire for advice now. So when mortgage rates and interest rates were as low as they were for the last 10 years, it was a relatively simple process in terms of applying for a mortgage, working out what you can afford, doing that analysis of what might happen to your budget if interest rates move either for or against you over the course of your term. When interest rates were as low as they were for the last 10 years, that was relatively easy. Now, obviously, given the interest rate volatility that we've seen over the last 12 or 15 months, we are just seeing people really in need of high quality mortgage advice. And really taking advantage of kind of speaking to our brokers as well. So we may be a slightly different market to the US, for example, but there is a really high quality mortgage advice industry in this country that can help people through these times. So when people are looking at the headlines or worried about interest rates, worried about their mortgages rolling off in 3, 6, 12 months time, there's lots of people that they can turn to for help. So the advice that I would give on that is, I wouldn't say it's never too early to be considering these things, but even 12 months out from either buying your first home or your current deal rolling off, you can speak to a broker and they can start to talk to you about, this is what interest rates are at the moment. These are what the rates are with the bank, because they're never quite the same as what you might see in the headlines. This is what your budget can afford, and start making the current environment specific to you. That's just incredibly valuable at the moment, and in my opinion, more valuable than it was for the last 10 years where interest rates were low and pretty static.
Yeah, that's good advice. And another one of your products, or like you kind of alluded to it earlier, was that you were kind of known as this spare change kind of investing app. That's changed a lot, but many people maybe not too aware of that. You do have the stocks and share ISA, which has really, really nice UI, if I do say so myself. What kind of insights can you give potentially with, let's say, investor behavior, retail investing behavior, because you have a quite a wide variety of different ETFs, like the iShares, kind of clean energy, and S&P trackers and things like that. Is there any maybe interesting insights that you can give with that behavior in terms of what people are like leaning into? Like, I know you have a robotics and AI, I'm pretty sure, with ChatGPT and artificial intelligence and generative AI. Are you seeing people move more to that? Fixed income as well, the rise of alternatives is becoming more and more kind of interesting. So what are you seeing from your customers' behavior on the investing front?
Yeah, it's interesting. So the kind of evolution of the investing side for us is we started with these starting options, so kind of cautious, balanced, and adventurous. And those were kind of off-the-shelf solutions. If you didn't really want to think about it too much, you just wanted to start investing, and you kind of self-selected your own risk profile. We then added in a kind of list of funds, some of those that you mentioned there, and then over the course of last year, we added in some individual stocks as well. But we like to think about that. We did it in a slightly different way, where we're really encouraging kind of good investor behavior. So it's all about kind of regular deposits, all about compound interest, pound cost averaging, all of these things that really help investors kind of grow their money over time. So the way that we added in individual stocks was heavily educating people that this is something that you should be regularly investing into. If these are companies that you're passionate about, it shouldn't really be a kind of... We don't necessarily want to be a trading house. We want to be a long-term wealth building service and helping people build their wealth with confidence over time. So we have seen a huge amount of people set up what we have as weekly deposits going into these individual stocks. So less about short-term trading and more about long-term wealth building. So in terms of the analysis kind of points that we've seen, that's been one of the more interesting ones that I've seen over the course of the last 12 months is the appetite there for people to learn about these things, these tools that will help them in terms of pound cost averaging, being consistent over time, and then setting up their regular deposits that go into these either fund options or individual stocks that they're passionate about. So you can offer these things, but we feel that we do that in a way that's probably going to help people as much as possible kind of build their wealth over time, ignore the market volatility as much as they can do, and invest in things that they're passionate about.
Yeah, I think that's brilliant, especially in the current macro environment. Like you alluded to, the fixed income volatility, equity volatility, the terrible war last year, interest rates rising. There's a lot for investors to digest. But, as we know, if you stay invested, stay diversified, generally you do pretty well over time and start to build your wealth.
Yeah, there's always news, as you well know, and if you're interested in these things, you can pay attention to them. But the things that's going to control your outcomes at the end of the day is your behavior, how you use some of the kind of helping hands that we've talked about today. So the account structures that you use, the free money that you get for the government, and then the consistency of your behavior over time. Absolutely, what you choose to invest in is part of the solution, but we shouldn't ignore the other parts as well. I think people focus sometimes a little bit too much on the end in terms of what am I actually going to invest in, rather than how am I going to do it, what accounts am I going to use, how am I going to control my behavior when market volatility comes along. And another trend that we're seeing is just a huge appetite for financial education, and I'm sure Finimize are seeing that as well. Everything that we put out there, people are really, really excited about reading and understanding what's going on. So it's just about getting the balance between that and then controlling your behavior and being really consistent with your savings and your investing, because that's the most important thing at the end of the day.
Yeah, I think it's exactly where I was going to go to. I think that education piece is so important, like what I do on a daily basis, which is, since 2008, you can basically put your money into an S&P tracker, QE forever, build your money over time. Life's easy almost in hindsight, obviously. Now the emergence of alternatives, the energy transition, private markets, stock picking, to some extent, thematic themes are going to be so important for building wealth over time, and that all starts with education. So how important, in your opinion, is education around ISAs and stuff like that, but also around the kind of longer term thematic themes? What are Moneybox doing on the education front to help guide customers and allow them to focus on that kind of long term wealth appreciation?
Yeah, it's extremely important. I don't think you'll find anybody that will disagree with that. But again, I'd reiterate the point about the appetite that's out there. So I'm sure you've seen that at Finimize. There's all sorts of people online providing really high quality financial education as well. So the appetite is absolutely there. So we basically put out as much as we kind of possibly can do in the areas that we think our customers are kind of passionate about. So we run a investing commentary on a kind of monthly basis, just saying, look, this is what's happened with markets. This is what it means for you. We're launching similar ones when it comes to home buying and pensions as well. So this is what's going on in the market. This is what it means for you. So it's that distillation from all of those headlines that you see, and all of the different sources of information that you can subscribe to these days, and then trying to break it down. What does that actually mean for me in my circumstance? Knowing our financial goals like we know our customers. So making sure that we serve them the right bit of content at the right time that's going to help them make really good financial decisions. So that's what we're trying to do. And as I say, we can't do this stuff quick enough at the moment in terms of the appetite that we're seeing from our customers.
No, it's brilliant. It's it's so important when it comes to home buying, saving, retirement, maybe some of the kind of alternative things that really can help you kind of secure kind of long-term future pensions, everything we've talked about. So look, Brian, it's been brilliant to get your thoughts on some of these topics, and manage to kind of come full circle. So thank you so much for spending some time, and I'll see you soon.
No, thanks for having me.